Hi. Let's learn about bad debt expense definition and methods for estimating. A bad debt expense is recognized when a receivable is no longer collectible due to bankruptcy or financial problems. Companies report bad debts as an allowance for doubtful accounts on the balance sheet. When a company makes a credit sale, it books a revenue credit and an accounts receivable debit. However, there is no guarantee the company will collect the payment, and accounting rules require the company to estimate uncollectible amounts, recorded as a reduction against net income. Two methods are used to recognize bad debt expense: the direct write-off method, which records exact uncollectible amounts, and the allowance method, which accrues estimated losses. Two primary methods exist for estimating bad debt expense: statistical modeling such as default probability and the percentage of net sales. These methods are used to determine expected losses on delinquent accounts. Amazon's 2021 annual report revealed details about its accounts receivables, allowance for doubtful accounts, and bad debt expense. Because bad debt expense is not explicitly called out in its financial statements, assumptions are made based on footnote disclosures about their allowance estimates. Consider a company going bankrupt that cannot pay all of its bills. Some of the people it owes money to will not be made whole, resulting in bad debt expense for those people who will not collect the funds they are owed. Bad debt is technically classified as an expense, reported along with other selling, general, and administrative costs. It represents a reduction in net income, having characteristics of both an expense and a loss account. Bad debt expense is reported within the selling, general, and administrative expense section of the income statement. However, the entries to record this expense may be spread throughout a set of financial statements, with the allowance for doubtful accounts residing on the balance sheet as a contra asset. Here are 5 key takeaways. 1. Bad debt expense is an unfortunate cost of doing business with customers on credit, as there is always a default risk inherent to extending credit. 2. The direct write-off method records the exact amount of uncollectible accounts as they are specifically identified. 3. In order to comply with the matching principle, bad debt expense must be estimated using the allowance method in the same period in which the sale occurs. 4. There are 2 main ways to estimate an allowance for bad debts: the percentage sales method and the accounts receivable aging method. 5. The allowance method creates a contra asset allowance account that reduces the net amount of accounts receivable. Hope this would help. Thanks for watching.